I think it's important to understand that even though there's a lot of deal flow, we say no a lot, it's not a one-size-kind-of-fits-all type of program that we're running. And so on average, I was just looking back at the data over the last couple of years, of all those 80-plus clients, we put maybe 4 clients in a fund as we're committing to it on average. And sometimes it can be less, sometimes obviously it can be much more. But I think in the end, what that shows you is that it's not just big, it's not just small, it's not just US, it is very diverse. So I guess the question is then, what do we see? And who is your potential competition in kind of making that investment decision making? Why the capital goes to one group versus really another? Big picture, I think by the data in the slide here, you'd see we see a lot in private equity. In fact, we're running at over, just focusing on the fund side of things, over 600 deals a year that we're looking at. And part of that is the proliferation of choice and niche deals and global access within private equity. We want to see all that. We want to see all the differences and the opportunities that are in the universe here today. I think it's interesting then to notice that we actually in diligence almost up to about 20% of what we're seeing. So this year we're going to see, it looks like up to 700 deals in the private equity, just fund primary world. And almost 20% of what we see will be on-site diligence, asking all those great intimate questions that sometimes people are prepared to answer and other times they're not. You can see from the bottom detail, and this is just really on primaries, that is all different kinds of funds. It's just not one thing. Whether it's by strategy, growth equity, secondaries, mezzanine, real estate, we put infrastructure into our bucket as well. Really anything, timber, minerals, they all kind of get put underneath the strategies of anything that is essentially private and liquid we're taking a look at. It's all over the globe. You can see this is just the last year, a lot more US focused in terms of fundraising. Certainly if you look at Europe at only 14%, that's a little bit low in the context of a 10 to 15 year history, but that also is a little bit indicative of how the last couple of years we've been leaning away from that market event. And then really, I think the interesting point, too, is the site visits by fund size. You can see almost a quarter of what we're actually on site doing diligence on is funds that are 100 to 500 million. And so very deal flow, and we try to spend a lot of time. I think the big picture answer is that we have to say no a lot. We like to build concentrated portfolios, and so in the end, it's about 5 to 6% that get through. We have a little data there on co-investments and secondaries. We're very active in those programs, in those types of investing, as you can see. But kind of what does this mean to you? And just stepping back, I put this in a little bit of the context of a 5 to 6%. That's not a very good ratio if I'm sitting kind of on the other side of the table. And I guess I am in some respect. My oldest is applying to college. And he is, but it's really we. I feel like we're working through this together. And we were touring Berkeley just to get a sense of, what the university is like. And this young, very enthusiastic young man was explaining to us how they got 80,000 applications for the last year and how they're going to spend 8 minutes on every one. And so I can guarantee you we're spending more than 8 minutes. But that's 80,000 essays that they're spending 8 minutes on. And what he said, I actually think is very applicable to kind of the way we think about things, is that it's not what you necessarily write in the essay. We've seen it all. We've heard it all. And I think a little bit through our deal flow we have as well within the context. It's the global general private equity. But it's really how do we get to know about how you think and who you are. And I think that's maybe the context to think of as you're kind of going into the private equity marketing environment. We want to know about how you think about investing. So to that effort, as we kind of get into diligence then, really what are we looking for? How do we think? How do we apply it? And how are you thinking about investing within companies, whether you're offering out co-investment and deal decision making? I tried to put it into some big picture buckets that are pretty relevant for today's market. Certainly value add has been around for a long time. If you haven't heard of a 100-day plan, you probably haven't been in the market in the last decade here. But everybody has a 100-day plan looking at portfolio companies. But I think it's really what you're able to achieve with that plan. And can you demonstrate that in actual dollars? And how do you go about measuring that? Those are the types of things we're kind of digging into a step further. Operations, it's pretty critical. Sometimes it's not something that has a lot of time spent on it. You might have an operation team. There might be a handful of CEOs that you call on. But really, what are the examples of the practices that you've used in terms of creating and developing value? Those are the type of things that we want to hear, see, and have it translate not into just the bullet point on the page, but the dollar and the related return. Risk management is not something we used to see a lot of within private equity, but it's certainly in the middle of the page and something that's a lot more highlighted today, in part because many of these things are areas that the SEC auditors have been spending a lot of time on. And whether it's the simple items of terms and key man, obviously that's been within this market really for some time, but let's make sure we're understanding the conflicts of interest. What is the background on litigation? We're going to dig in there and understand anything that's happened within your organization. Compliance, back office. It's amazing how many people over the course of time, funds, managers have gotten tripped up just by not having good back office operations. And how are you managing those risks associated with it? When we're working with sovereign wealth funds, that's actually one of the areas that they care very much about. It's interesting on the U.S. public pension funds, that's not a typical kind of upfront question, but we have sovereign wealth funds who come in and audit us for how we're auditing you on your back office operations and risk management there. And certainly I should just put SEC audit up there as well. When was your last one? How did it go? Yes, we want to hear all about it. We go through the same thing as well. It's not a lot of fun, but it's much better to kind of have it done and checked off the list as opposed to having it come up later. Replicability. I actually think this is a really interesting question because many times with funds, we see a couple of just great winners, and they may be 5, 6, 7 times your money, but it was a $2 million investment in a $100 million fund. And is that really where you're going to be when you're raising the $450 million fund? Are you going to do that deal again? And so it's context and replicability of, it's a great deal, love it, glad we all made capital there, but what are you going to really do in that next cycle? And how are you going to apply it? Context is something that we spend a lot of time on, in part because we end up having a lot of data. Remember what the last number is, but whether it's 2,000 or 3,000 different funds in the database we've collected over the course of time. These aren't just funds that we've invested with, but over the course of our 80 to 100 clients that I've been investing within private equity, we really have all our collective historical cash flow data. And it's very interesting to do benchmarking. It's very interesting to compare benchmarking between the data we have that we know is actual compared to Preqin, compared to Cambridge. Interesting data point. Half of Cambridge's data is for funds at under $500 million in size. And so when you are benchmarking yourself, is that relevant? Does that make sense? Are we kind of an apples-to-apples basis? Or really, what's the underlying context of that benchmark is kind of one of the questions we start to ask. And then last just is innovation. I think in this market, we're seeing more and more outside of the box thinking. I think it started with a lot more of the distressed debt opportunities that were being developed post GFC, the global financial crisis. But we're starting to kind of break those classic private equity boxes of 2 and 20 and saying, what else can we be doing on the innovative structuring side, even in terms of investment opportunity and technology. So really, what is our process? What do we think is different about kind of Hamilton Lane as you're working with us? What do we do? So I guess just a couple of things. One, we like to diligence pretty early. Sometimes this means that returns may have changed by the time we're done with diligence, and we may have a client 6 months down the road kind of starting to get up to speed there. But we like to be early because, in part, we like to make sure we understand the allocation, understand the metrics, and if we can drive some of those returns, we find that's pretty helpful. We generally aren't watching what our peers are doing. Good or bad, our peers are doing different things. I think I heard earlier one of our peers was investing in 175 funds this year. It's a much better odds. Maybe you want to go there to go kind of submit some of your proposals, but we're much more concentrated in terms of what we're doing, and that 5 to 6% rate is kind of what we'll see. And we like to compare options globally. And it's just a fact of the matter that 10, 15 years ago, people didn't really think about. But when we're investing in a $750 million middle market fund, we're not only comparing this maybe Southeast US-based fund within the context of their peers, but where else can we be investing that dollar? And how is middle market Australia doing? And what's going on in Germany? And so across the board, we can be very fluid with dollars and capital, and we need to make sure we have good context for why we want to spend and have the exposure to the US dollar really versus some other means. Right now we're very bullish on what the US market has to offer for the next couple of years, so it's still probably a good bet. So just a quick summary then on the process. We do a screening on every single deal that we see, 600 to 700 different funds a year that is, and it is more than 8 minutes. We have people that are dedicated to it. It comes through our investment committee. And so yes, I read every deal that comes through. We make a decision on it. It used to be a lot easier when there wasn't so many, but kind of do our best to keep those names all straight. We talked a little bit about our peer competitor analysis. That really is a big piece of how we're making decisions, and we want to understand that. Probably flip down to legal and negotiation. We have a pretty large in-house legal team. And so what that translates into is we use them during diligence. If there's questions that are coming up, certainly on the transaction structuring side, there's a fund manager that's in market that we actually spent the first 6 months on working with them in terms of what we think their fees ought to be and how we can structure that to be a little bit more attractive to the market prospectively, kind of even before they came out into kind of the public arena. And I think it's done well for them. And we also like to spend a lot of time on advisory boards. And as you'll see, we are about creating relationships. And that gives us some good insights. So what do we like? Well, I guess first we talked a little bit about the music, guitar theme that goes through it, and my assistant and I are both 1970s, 80s children. We came up with the romantics here. Tell me everything I want to know. So we like early looks at deals we talked about. We like good allocation. Consistency. Very often we'll look at different managers, and so the aggregate overall return will be a nice number through a couple different funds. But when you actually dig in and you're seeing the volatility within some of the deals and the returns and the risk they took, that's a different animal than somebody who's doing more consistent deals and transactions. And we want to be smart. It's not that we're going to do one or the other. It's that we want to be smart about how we're building portfolios. So it's not just the deal, but it's really how the portfolio is going to fit together. So we'll take some higher risk bets, and then we're going to take some lower risk bets. We like transparency. Strategy and relationships. So just to blow up on 2 of those points. On strategy, we're building dynamic portfolios, and to spend a moment there, that top set of pies is not supposed to be something that you really can see what's written up there, but more just the differences in colors really by vintages. And the point being, whether it's geography, whether it's the type of the underlying deal, buyout, venture, special sit, what have you, whether it's the underlying industries, we're building dynamic portfolios. We're not always going to be a third buyout, a third venture, a third special situation. We are taking context of the market into our investment decision making. You can see that changes and evolves over the course of time. So strategy matters. Is it the right fit for the right time as we're building this portfolio? And then relationships. I referenced it a little bit. Relationships are pretty key for us. This is a great example of a relationship that was developed over the course of time, really over the course of a decade. Their first fund, the first fund of theirs that we invested in, we were a very small investor, 3% of their fund. And then, lo and behold, a year or 2 later, there was an interesting co-investment. We did that. And a couple years after that, the general partner had a high net worth individual who was selling. Okay, we have some capital for that too. And they wanted to keep it kind of within an interesting family and sent it over our way. We appreciate that. We like that. They launched a new strategy and had a dedicated team. And we backed that actually with some sizable capital, and it's done well. And a couple more years down the road for one of their additional funds, we backed them along the way, but brought more capital to the table. And so I think the point being, we know them, we're on their advisory board, we trust them, we see a lot of different ways to work together, and we're trying to be thoughtful and dynamic in that way. And of course, performance. Performance matters. So what don't we like as we're thinking about managers and looking at funds. Most of this should probably be obvious, but sometimes I guess it's just good to state the obvious. We don't like surprises. We do work with a lot of public pension funds here in the U.S., but whether they're public or they're a sovereign wealth fund or some other entity, nobody likes to be surprised. If a general partner, if a manager had an issue, if there's a deal issue, we do like that call ahead of time. As we're doing diligence, we want to know what we're going into. We don't want to discover it after the fact as we're in the middle of diligence. It's much better to explain up front what happened and have a thoughtful approach to it, as opposed to something that we find out through kind of rather extensive, really off-the-record references that we're doing and things along those lines. Misalignment, we like good alignment. I put greed in here too. It sounds a little aggressive, but it's just, it goes to alignment. And it's really more about making kind of smart choices. Transaction and monitoring fees are one of my personal nemesis that we try to manage down as much as possible. I appreciate kind of the need on the smaller fund side of things, but we like to make sure we are aligned with our investors. I think it encourages us all to make smart choices. And then, I guess, what do we notice? And it's always interesting when you spend time in diligence, or even kind of in some of the initial meetings, just who talks, how they work together. Is there one person dominating the conversation? And what's the opinion? You ask the hard questions, kind of where do all heads turn to whom and why, and how's that answered? That's that more art side of the diligence that I think actually has a big impact on things. Who gets to carry? I think in any business, you should follow the dollar. It makes it, you start to understand how decisions are made to some extent. So who gets to carry? Who owns a management company? And what's flowing through there? We do a lot of work around that. Some are more comfortable with it, some are less comfortable with it, but we do think the transparency of that and the understanding, the fact that we can keep a lot of that confidential because we've been doing it for 20 plus years is pretty reasonable. But we want to make sure your skin's in the game, that we're aligned, and we understand when we hit hard times where things are going. Interesting enough, one of the co-investments we did was in a European company, and it was Italy, of all places at this point, but it sounded good at the time. And they were having a little bit of a rougher go of it. We're watching on a monthly basis, so we're kind of watching the numbers come through, and it just wasn't making sense to our team. And so we're calling the manager, and then we're not getting a response. And so we went, we went to our chairman, who knew the top of the entity, and started spending some time saying, hey, your fellows are not responding. And I mean, basically, the management team had kind of dropped the ball on spending capital and time and attention in their research pipeline as opposed to just on their sales pipeline. And it took a bunch of notches kind of back up that ladder to reposition, to say, hey, we're going to be there with follow-on capital because we want to save these assets here in this deal, but you've got to start paying attention to what's going on here. And so I just back to the point of it's a relationship, we want to be smart about it, and we're going to make sure we use our resources to do so. Oh, that last one of you still holding a portfolio company from 2007. You'll be amazed at how much capital is coming out from older transactions and really funds and deals at this point in time. I think it was about 20% of all the distributions that across globally our clients received was from 2005 and older funds. It's just amazing how long some of these holding periods are lasting. So 2007 isn't good. So what's in today's market? What's interesting, kind of what's challenging, how's it looking? We continue to like an early look. We like to be innovative and wait to see people being innovative. It doesn't necessarily mean it's increasing risk, but how they're going about perhaps managing even their fees and their terms. So we're seeing more in this market of being thoughtful even at the portfolio management side of things. And so it's not just the deals. And I know everybody thinks about the deals and how is this fund doing and what's the deal. But there's a spread there between on the growth side and the net side and how you're managing that cash and what's going on and kind of what your timing is and how do your fees all play into that. And so we're starting to even see funds that are being a little bit more, we've consulted some funds, but we've seen others that are being just a bit more proactive in trying to manage that quote-unquote J-curve and coming up with innovative management and kind of carry structures for the organization. So we're still aligned, but we're trying to kind of fix some of that gross to net spread. What's challenging? Actually, what's been interesting in a little bit this market has been the kind of fund allocation / timing, meaning we'd like to be first, but what happens if we're last? We kind of still hold the allocation there, and some funds have actually started to roll pretty quickly, and it kind of translates a little bit into mismanaged fundraising. And so just to be smart about that as you're approaching investors and hoping to create long-term relationships. Some of our clients think in terms of 10 years. A lot of our clients think in terms of 30 years. And so you want to make sure even on the front side of that process that it is a positive experience. It can be tough. I mean, it's nothing better than having an oversubscribed fund and have to manage through those great choices that you have to make through different investors, but kind of a bitter taste for investors that don't get it can last a pretty long time. And just the volatile markets. One of the questions that we're watching is how are private equity managers in this, and what has been a stronger market, how are they going to really be able to compete with that? Because we do benchmark against peers, but we benchmark also against just the public markets, and it's tough. We're a little bit slow in private equity to kind of generate returns as quickly, and so we have to be thoughtful about that. So who gets through? Just to give a little perspective on that, we're very focused on outperformance. We're not building an index. There's not a lot that get through that 5 to 6%. But just to kind of give a sense of what a couple different clients may look like as we're making commitments across their portfolios. So for 3 to 4 years, we may be doing 15 deals. We may be doing a little over 20 deals in the course of that cycle. It's global. It's some U.S. It's a lot non-U.S. It's some small mid-market, some large. There was a question asked earlier about what do you think about the large investor, the large fund manager? And I think what's a good answer is, we agree with. It's a very kind of stable part of the portfolio, and it goes back to what does a client need? Are they reaching for risk? Are they comfortable just to get some basic market outperformance, or what else are they going to need to be able to develop to really exceed what their benchmarks are? It can be distress, it's VC growth, so it's a little bit of everything. Just to give a sense of, it's concentrated, it's very diverse and broad, and it's anything having to do with the illiquid private markets. I think one of the questions we're asking ourselves, and we really think that investors ought to be asking today, is how are we going to continue to perform when we're up against what has been a pretty strong bull market so far. I think that's going to be tough for private equity to answer. So I guess in summary, what haven't we covered as much? Returns, liquidity. Got to put returns in there somewhere. It's real, it matters. We've certainly been seeing just a tremendous amount of liquidity. That's good for all those raising funds at this point in time. We definitely have to reinvest it somewhere, but for some it's a little even bit of a double-edged sword where it becomes this burden of having to reinvest it, but there's a lot out there, and so good from the fundraising market. You can see it in the fundraising numbers. Our bigger concern, quite frankly, is the deal volume, and we're just not seeing it in the deal volume yet be able to keep up with what the fundraising has been. Worst mistakes: raising too much, missing liquidity opportunity. There's so many stories where, boy, we had that at 4 times our money and then something changed, and we're kind of eking back at cost. So just be smart about that. Don't hold it too long, and be thoughtful from a cash management perspective, kind of at that gross to net spread, how you're thinking about your portfolio. And I guess big picture, we're always happy to talk to everybody. And so we have a centralized investment process. It all kind of goes through one online site that we then filtered out to the 220, 250 people around really the world, wherever it makes kind of relevant. So this is really the best place. If you have information to send it, it will make sure that it's taken a good look at. I think that's it.